Hi, everyone. Welcome back to Wade into Wealth. We return as summer 2023 comes to an end, and I'd say it's on a bittersweet note. Obviously, if you're a kid going back to school, I know my kids feel that way, and you've got one taking the long trek to kindergarten this year, which is very exciting.
Yep.
Along the theme with that, though, something that's not exciting at all if you have student loan debt that you haven't been making a payment on for the past 3 years is that starting this coming Friday, September 1st, student loan repayments begin again. And that follows 3 years of the student loan payment pause that started during the pandemic. Interest had stopped accruing on loans. Interest is going to restart accruing on loans again, and you have to start making payments. And this is something that, quite frankly, I don't think has gotten nearly the amount of attention that it should have gotten, but it's a big deal. And I think it's something that a lot of folks aren't prepared for. So we're going to talk today about the potential impact on the economy. And also, if you're a borrower, listen, it's kind of late to be making significant changes in terms of how to pay for your student loans once again, but some strategies to once again try to help you manage and mitigate the resumption of student loan repayments. Let's start with just some numbers on how big of an issue this is.
Well, we're likely to see an impact to both from a personal finance standpoint because 40 million Americans have student loan debt. Now, that doesn't mean that all 40 million have not been paying on that debt for the past 3 years, but a very strong majority of them have not. And there's likely to be an impact on the economy and just the behaviors of the consumer because you've had the past 3 years where you're not making these payments. And all of a sudden, not making those payments for that long of a period of time makes it seem like you never have to make that payment again. And maybe you made some decisions along the way as if you didn't have that payment coming back. But reality strikes again, and here we are. The average student loan balance is just under $40,000, and the average monthly payment hovers right around $500 a month, which broken out or multiplied for a full year, you're talking about $6,000 every single year, net of taxes, that a lot of people have not been paying a single penny on for the past 3 years.
I think the number amounts as a whole, as the country, to about $10 billion a month.
That's
that
real
needs
money
to be repaid. That is a significant number. But also, when you look at it and say, all right, if you're a household and now you have a $6,000 a year expense that's added on, that's problematic.
Well, it's also problematic because you probably spent the past 3 years taking on a little bit more debt because you're not making this payment, and all of a sudden you have an extra $500 in your monthly cash flow that, unless you were very disciplined and organized and had stayed on top of it, it's easy to forget about it and forget that that can come back, whether you're getting that car payment, the new car payment that maybe is $100 more every single month, or you sign up for another personal loan, or you put something on a credit card, and that's an extra $100 a month. And on the surface, when you have an extra $500, that's no big deal. But now you start to add that up, and then that $500 comes back, and that's a meaningful impact.
Yeah. This is one of many decisions that were put into place at the very beginning of the pandemic. And we don't need to hammer whether they were right or wrong. They happened. And I think, there's a lot of people that have made a lifestyle out of complaining and second guessing things that happened. Look, they happened. Here's where we are today. But what happened is that when the student loan repayment pause was put into place in early 2020, it coincided with an increase in higher credit scores for most people who actually had more cash on hand than, in many cases, at any time previously, because there were government stimulus payments that were being made. A lot of people stopped spending as much money as they were in the pandemic, because you weren't going out, you weren't doing social things, and at the same point in time, low interest rates made it really easy to take on more debt, whether that was for a car, whether that was for a mortgage or whatever it was. But there wasn't a ton of cash being saved. In fact, there's a report from the Consumer Financial Protection Bureau that found half of student loan borrowers have at least 10% more debt now than when the payment pause began.
Sure. I mean, they didn't have to make a meaningful payment, and all of a sudden, other purchases get a lot easier to be made.
in short, people didn't save the money.
And they didn't keep paying it.
And haven't accounted for having to, in many ways,
Ever have to
haven't
start paying it
accounted
again.
for having to start repaying it. I think.
And I think the
Go ahead.
sorry, the other side is there was such talk about student loans being forgiven.
Mm-hmm. Yep.
And, you know, it's kind of like when you're going to the casino, you think, well, what would I do with that jackpot? Or the Powerball is probably the best example.
Sure.
Well, if I win that Powerball, what would I do? And then they only start to think, well, what about when I win? And you don't think about the other times. Well, this will be okay because when that student loan debt gets forgiven, it won't be a problem until it doesn't get forgiven. And then that student loan debt comes back and you have these extra expenses that you now have to bear as well.
That's a psychological thing that we very often do and especially
Everybody
with
does
investing.
it, yeah.
We project out the positive as if it's happened, as if it's a reality, and we often don't necessarily account for the other side. What if an investment goes wrong? You don't win the Powerball, or student loan payments have resumed, and there were a lot of folks that I think banked on things being forgiven. For the time being, it appears as if that's not going to happen. I think it's pretty unlikely overall that it will happen. So what does this mean for the economy? Let's start with that. We'll talk economy, and then if you're a borrower who's got your loans restarting in 2 days, what do you do? Or what are some things you do? Economy first.
Well, for the economy, it means that people are going to have less discretionary money, less expendable income to go get that patio furniture or frankly, for anything. Because we're talking about student loans, but we're also not touching on the inflation that we've all been experiencing for the past year and a half. So the two of those coming together means that your money does not go nearly as far as it had previously. And now you're going to have this extra monthly payment, which is meaningful, which means that now you have to stretch that dollar bill a little bit further, whether you're getting groceries or you're just going to the store to shop or you're getting gas for your vehicle, whatever it may be. And we're seeing retailers specifically. You know, you think of retailers who maybe are on more of the want side of things, the Amazons, the Targets of the world. You know, Walmart has a significant grocery business, but we're seeing all of them come out and are very likely to lower their guidance, their sales guidance.
Many have.
In 2024, correct. Procter & Gamble just slashed their 2024 guidance, meaning they're expecting their sales and revenue to not meet the expectations that they had previously because people are likely to be spending less money.
What they're saying is we expect people to have to try to find ways to cut back.
Yep.
And you can't necessarily cut back on your rent or your utility payments. It's a challenge to cut back on groceries and things like that. But here is where we may see people trying to make an adjustment. Do you go from the brand name cereal to the store brand? Do you companies like Foot Locker, TJ Maxx, places where you don't necessarily have to go, but you go because you want to. Home Depot, Lowe's, a lot. You've seen that the last couple of years. People putting off home projects because it's gotten really, really expensive. And I think of eating out too.
Yep.
A lot of restaurant chains have come out and said we expect this to be problematic because eating out's gotten really expensive.
It's gotten incredibly
lately.
expensive.
Sneakily and quickly, it's gotten expensive to eat out.
You can go to Panera for 4 people, 2 of which are young kids, and it's like $70, $80.
Which is
for a meal, which is outrageous because you don't have any left over. That's the meal.
Yeah. And so I also think of companies like Grubhub that are public companies now. I think of that and you say, all right, well, can you avoid the $5.99 convenience fee, the $3.99 delivery fee, and it adds up really quickly. So there are likely to be impacts felt in the economy, especially if you're an investor. An opportunity to maybe take a look through your portfolio and see if there's places where you have some exposure there. What if you're a borrower?
Well, it's real simple. You got a budget.
Yeah.
And we talk about this all the time, but we talk about it all the time because of how important it is and how easily overlooked it is. If your student loan payments are resuming, you have to get an idea of what your monthly budget looks like. You need to know, are we okay with this? Or do we have to find cuts at other spots of our monthly budget where we're spending money so that we can now fit this payment into our bills? Because if you're paying out more than you have coming in, that can only last for so long. And that becomes a real problem and very detrimental to your long-term financial future.
It's really not sustainable, and it does sound really simple. There are apps you can use, Mint, Credit Karma. There's a lot of apps that will do the budgeting for you. You have to give them your information, and they'll do it for you. There is, too, I think if you're feeling some anxiety or stress about this, which we know people are, and this looming payment that is going to restart, there is a pretty significant psychological benefit to laying everything out, seeing it in front of you, and being able to go through and say, okay, here are areas we know we can cut. I would look at streaming services. Okay. It adds up in a hurry. Netflix, Hulu, Paramount Plus, Amazon, I mean, whatever.
Yep.
Those are things you don't need.
Right.
Those are luxuries. And you know what? If you've got, I think the average household has like 4 streaming services. If you cut 2 of them, that's $25 in a month. Okay. It doesn't get you all the way there, but it's a start. And the same with things like eating out and so on. So as simple as it sounds, I'd start with a budget.
I couldn't agree with you more. You know, the apps make it easy and they're convenient, but they're not going to give you the benefit of you going through the budget yourself and tracking what your expenses are. You're going to have a much better handle on things if you take that time to do it yourself and not just rely on an app to categorize some of your expenses for you, because you can then determine what you need and what you don't to be able to make an informed decision on what adjustments are available.
Yeah, an app will give you the data. You have to execute.
Yep.
Simple, not easy.
Yep.
But certainly problematic if you don't do it.
And the interesting thing is, you know, when you go 3 years without making a payment, these loan companies all end up in a lot of places end up consolidating. So you really want to make sure that where you're about to start sending your money is still the organization that has your loan.
Yes.
Because it's possible they've been acquired or your loan is with another venue or organization now, and you want to make sure you're sending the money to the right place and in the right fashion.
Along those lines, if you were making automatic payments, do you still have the same bank account?
Right.
If you've changed a bank account, the loan servicer isn't going to know that.
Yep.
And you need to log in and change it, because you don't want to start having missed payments too, because there's penalties for that. So you will absolutely want to confirm your method of payment, the bank account that's being used to make those payments. It's really important. Is your loan set up to auto draft? That's another thing, is that if you're not having it auto drafted, many companies will offer you a very modest discount on the interest if you set it up to have it auto drafted. I would also look at the payment plan that you were on. And I actually remember doing this when I'd gotten out of college, was working in TV and living on a deficit, making less money than I was spending. and not spending on wants, but on rent and things like that, and having to go onto the income-based repayment plan, which is your monthly payments are determined based on your income, and typically it's 10% or less of your annual income. So it can be adjusted. If you're paying too much, you can potentially adjust it to have a smaller payment. The problem with that is, the downside of that is that in many cases, if you're on an income-driven repayment plan, your payments are not likely keeping pace with the interest.
Oh, no, you could be paying
accruing
on that for your entire life.
So I would say think of that as a short-term fix.
Yeah. And in a last case, last resort scenario, if you have to use something like that. It's there and it's available, but if you're making those payments or on that type of structure, you're going to be paying on that loan for
long time.
Decades upon decades.
Long time. The other option that's likely kind of out the window now is refinancing your loans.
Right.
Because interest rates have risen. You can still examine it, but I don't know that the rates are going to be nearly as attractive as they were. And here's the other thing. Look, if you have room in your schedule, a part-time job, or some other way of earning some extra income isn't going to hurt if you can dedicate it towards putting it on those loan payments, because interest is also restarting. Even with interest rates at historically low levels, most student loans, 5% minimum. They were at 5% or higher, and so it's a pretty significant rate of interest.
There's also a lot of, if you're really serious about getting out from student loan debt, there's a lot of strategies to use and to employ. Most people don't just have one loan. You will have a series of a bunch of little loans that all have their own balance. They have their own interest rate associated with them. Mm-hmm. And so there's a number of ways and a number of strategies that you can use to start paying some of those off, and then using the monthly amount allocated to that portion towards other parts of your loan. So you have some options if you're really serious about it, and if you're disciplined, you can get those paid off at a pretty quick pace over the span of a 5 to 10 year period.
Yeah, this one will be interesting to watch, because I think there's ramifications for individuals, for the individual borrowers, and likely coming for the economy as well. So We shall see. As always, don't hesitate to reach out if you have questions or would like some guidance. We've got a staff at Brighton Securities, both Ethan and I, and a lot of other folks that are willing to help and at least talk through a conversation that might help you get closer to having a plan. Thanks for joining us. This is Wade into Wealth.